Somewhere in a Wall Street office right now, there's a fund manager who used to make 7 figures a year and he's terrified of a machine that doesn't even have a face. It's not artificial intelligence. It's not some hedge fund algorithm. It's something so boring, so unglamorous, that when it first launched, almost nobody wanted to touch it. It's called an ETF. And in the last 30 years, it has quietly taken over the entire investing world, without a single headline that told you it was happening. Right now, trillions of dollars are sitting inside ETFs. More money than most countries make in a year. And most people using them still don't fully understand what they actually own. By the end of this video, you're going to understand something most investors never figure out: how a product that Wall Street once mocked ended up rewriting the rules of who gets rich in the stock market, and who gets left behind. But here's the part that's going to surprise you. The rise of ETFs isn't really a story about investing. It's a story about trust, psychology, and a slow, silent shift in who actually controls the market. And that shift is bigger, and stranger, than almost anyone realized while it was happening. Let's go back to the beginning, because the origin of ETFs sounds almost too simple to be revolutionary. An ETF, an exchange-traded fund, is basically a basket of investments. Stocks, bonds, sometimes both. Instead of picking one company and betting your money on it, you buy a slice of hundreds, sometimes thousands, of companies at once. Think of it like a fruit basket instead of a single apple. If one apple goes bad, it barely matters. You're not relying on one thing to save you. Simple idea, right? Almost too simple. And that's exactly why, when the first real ETF launched in the United States in 1993, nicknamed the Spider, tracking the S&P 500, nobody on Wall Street took it seriously. Professional investors were used to feeling smart. They picked stocks. They read reports. They believed they could beat the market through skill. An ETF didn't offer that feeling. It didn't promise genius. It just quietly followed the market, without emotion, without ego, without a star manager's name attached to it. And in an industry built on the myth of genius stock picking, something that admitted, "I'm not trying to be brilliant, I'm just trying to match the market," felt almost insulting. So for years, ETFs sat in the background, overlooked, underestimated, treated like a gimmick for people who didn't know what they were doing. Which is exactly why what happened next is so fascinating. Because while everyone was ignoring ETFs, something else was happening behind the scenes, something that would eventually make them impossible to ignore. Actively managed funds, the ones run by expert stock pickers, kept charging investors high fees. 1%, 2% a year. That might sound small. It isn't. Over a few decades, is the difference between retiring comfortably and running out of money at 75. And here's the twist that started shifting everything. Study after study began showing that most of these expert managers weren't actually beating the market. Year after year, a majority of them underperformed a simple, low-cost index, the kind of index an ETF could track automatically, for a fraction of the cost. Imagine paying a personal chef every night, only to find out a $12 meal kit tastes just as good, most of the time. That realization didn't spread instantly. It spread slowly, quietly, through data, through investors who started asking uncomfortable questions about where their money was really going. And once people started asking those questions, they couldn't stop. Because ETFs didn't just make investing cheaper. They made investing feel safe enough for people who were previously terrified of the stock market altogether. Diversification, spreading your money across many companies instead of just one, used to require serious money and serious research. Suddenly, with a single ETF purchase, a 25-year-old with a few $100s could own a piece of hundreds of companies at once. It democratized ownership of the market in a way that had never existed before. And once that door opened, it didn't just open a little. It swung wide. By the 2010s, money that used to flow into actively managed mutual funds started flowing out, and pouring into ETFs instead. Not in a trickle, in a flood. Retirement accounts, robo-advisors, even hedge funds started using ETFs as tools. What began as a niche product for skeptics became the default choice for almost everyone. This is where the story turns from boring financial product into something closer to a psychological shift for an entire generation of investors. Because here's the thing about trust. Once you lose faith in the expert, you don't just walk away. You look for something you can verify yourself. ETFs offered exactly that. Transparent holdings, low fees, the ability to buy and sell instantly, like a stock, any time the market was open. No waiting until the end of the day like older mutual funds required. For a generation that grew up questioning institutions, questioning banks after 2008, questioning experts after watching them fail, an ETF felt different. It didn't ask you to trust a person. It asked you to trust math. And that single shift, trusting a system instead of a person, changed everything about how everyday Americans started investing. But convenience and trust alone don't explain a multi-trillion-dollar takeover. There's something deeper here. Something almost invisible. Because ETFs didn't just make investing cheaper. They made investing feel safe enough for people who were previously terrified of the stock market altogether. Diversification, spreading your money across many companies instead of just one, used to require serious money and serious research. Suddenly, with a single ETF purchase, a 25-year-old with a few $100s could own a piece of hundreds of companies at once. It democratized ownership of the market in a way that had never existed before. And once that door opened, it didn't just open a little. It swung wide. By the 2010s, money that used to flow into actively managed mutual funds started flowing out, and pouring into ETFs instead. Not in a trickle, in a flood. Retirement accounts, robo-advisors, even hedge funds started using ETFs as tools. What began as a niche product for skeptics became the default choice for almost everyone. And this is where most people stop paying attention, right when the story gets dangerous. Because here's what almost nobody talks about: the same thing that made ETFs powerful also made them risky in ways most investors never think about. When you buy an ETF, you're trusting that the fund actually holds what it claims to hold, that it's priced correctly, and that during a crisis, you can sell it exactly when you need to. Most of the time, that's true. But, most of the time isn't the same as always. During extreme market panics, moments of true chaos, some ETFs have shown cracks. Prices that briefly disconnect from what they're supposed to represent. Liquidity that seems endless, until suddenly, for a few terrifying minutes, it isn't. It's like a bridge that holds thousands of cars every single day, so people stop imagining it could ever collapse. Then one day, under the wrong pressure, at the wrong moment, it wobbles, and everyone remembers it was never actually unbreakable. That risk stayed mostly hidden, because ETFs rarely failed in the ways people feared. And that quiet reliability is exactly what let them grow into something even bigger, and far more powerful than most investors ever expected. Because somewhere along the way, ETFs stopped just being a place investors put their money. They became one of the most powerful forces in the entire stock market. Here's the part that should genuinely surprise you. A handful of companies, a small group of asset managers, now oversee an enormous share of the money sitting inside these funds. When you buy shares of an S&P 500 ETF, you're not just investing in the market. You're handing a tiny sliver of voting power over corporate America to whichever company manages that fund. Multiply that by millions of investors, across thousands of ETFs, and you get something almost nobody saw coming: a small number of asset managers holding enormous influence over how public companies are run, not because they built those companies, not because they run those companies, but because they manage the funds so many people trust to hold them. Let that sink in for a second. Ordinary people, just trying to save for retirement, unknowingly handed a small number of institutions some of the most concentrated influence over corporate America that has ever existed. Not through some conspiracy. Not through anything hidden or illegal, just through millions of individual decisions to choose simple and cheap over complicated and expensive. Which brings us to the real twist in this story. ETFs didn't just change how people invest. They changed who quietly holds power over the companies we all depend on. Not billionaires making dramatic takeovers. Not headline-grabbing corporate raids. Just funds, calm, automatic, almost boring funds, accumulating influence one small, ordinary investment at a time. Something that started as a way to make investing simpler for regular people slowly became one of the most powerful forces shaping the entire economy, not through force, but through sheer scale. And the wildest part, most of the people who made this happen have no idea they were part of it. They just wanted a simple way to save for the future. They didn't set out to reshape corporate America. They just wanted to stop paying high fees to people who weren't beating the market anyway. But that's how the biggest shifts in history usually happen. Not with a single dramatic decision. With millions of small, reasonable choices, all pointing in the same direction, until one day you look up and the entire landscape has changed. So the next time you glance at your retirement account, or see three little letters like SPY or VOO sitting quietly in your portfolio, remember this: that ticker isn't just tracking the market anymore. It's part of the reason the market looks the way it does today. And the real question isn't whether ETFs are good or bad for investors. It's this: when millions of people quietly hand their decision-making to the same small set of funds, who's really in control of the market anymore? The companies, the investors, or the invisible machine sitting quietly in between them both? The one nobody was watching closely enough, until it was already running the show. If this video changed the way you think about investing, you're going to enjoy what's coming next. Every week, we break down the biggest stories in business, money, and the hidden forces shaping the economy without the confusing jargon. Subscribe if you want to understand how the financial world really works, one story at a time.